Gold is approaching a major liquidity zone where smart money is actively preparing the next move. We aren't guessing today, we are reading the institutional footprint.
But here's the problem. Most retail traders are looking at the completely wrong level right now. My primary focus today is a highly specific buy setup below key internal liquidity. But there's a major condition that must happen first. If price aggressively expands straight through to our target without retracing, that creates a premium short opportunity. However, if the market behaves exactly as engineered, we're looking for a very specific discount sweep first. Let me show you exactly where institutions are targeting and how we'll execute the setup in this explainer.
Looking at the daily time frame, there's an aggressive, undeniable upward expansion right off the 4,000 base. The macro bullish bias is fully confirmed above $4,500. Smart money has stepped in, engineered accumulation in a deep discount, and displaced higher. The overarching institutional order flow is dictating higher prices, and fighting this macro trend is exactly how retail accounts get zeroed out.
Before we go any further into the theory, here is today's executable trading plan. Our primary direction is a buy, utilizing a limit or confirmation model. The entry zone is strictly between 4450.00 and 4462.00. Our primary target is the external buy-side liquidity resting at 4526.35. And the hard invalidation, where this entire thesis is completely broken, is a clean 4-hour candle close below 4430.00. You now know the exact outcome we're looking for. Now, let's break down the institutional reasoning behind why this works.
Dropping down to the 4-hour perspective, the draw on liquidity becomes incredibly obvious. Smart money is magnetically drawing price to the external buy-side liquidity, resting just above the recent swing high at 4526.35. There is unfinished business up there. Essentially, it's a massive cluster of resting orders that institutions want to trigger for profit. But institutions cannot simply buy at current prices without first securing enough counterparty liquidity to fill their massive orders. They need a catalyst.
$4 billion. That is the fundamental engine driving this technical setup. The US Treasury recently announced it's doubling its bond buybacks to at least $4 billion per operation to support market liquidity. This massive injection serves as the macroeconomic fuel for dollar weakness, which directly translates to gold's markup. But that's not the only catalyst in play right now.
We actually have a perfect storm of macro catalysts converging all at once. Alongside the US Treasury's multi-billion-dollar debt buybacks, we have severe economic sanctions on Iran announced by Donald Trump, which heightens geopolitical tensions. On top of that, the FOMC minutes just confirmed officials are acknowledging sticky inflation, bringing stagflation fears right back to the table. Furthermore, the UAE has suspended trade with Tehran amidst regional missile attacks. I'm not pointing these out to give you an economics lesson. These are the exact high-impact volatility events that algorithms and institutions use as cover to violently engineer liquidity sweeps.
This brings us to the timing. Upcoming US data releases in the New York session, like unemployment claims and the Philly Fed Manufacturing Index, align perfectly with the structural need to sweep internal liquidity. Institutions will use the volatility injected by these news drops to quickly push price down, sweep out early buyers, and tap into the 1-hour fair value gap before completely reversing it.
So, how do we safely enter this volatile environment? We demand an institutional footprint. Specifically, a 15-minute bullish market structure shift. We aren't just looking for any random upward bump. We need a violent shift to the upside that strictly occurs after, and only after, the market has swept out the lower liquidity. That specific sequence is our green light. It confirms smart money has finished accumulating short-term sell stops and is finally ready to displace price higher.
Right now on the 15-minute time frame, institutional confirmation is completely absent. The market is currently in a lower high, lower lows structural pullback. We're in a distribution phase designed to rebalance price back into a discount. Getting long right now is simply gambling. We need to see the algorithm actually change its state of delivery.
Here is the exact, methodical, institutional entry procedure you must follow. Step 1. Sit on your hands and wait for price to sweep the internal sell-side liquidity resting between 4460 and 4480. Step 2. After that sweep, look for a 15-minute bullish market structure shift accompanied by true energetic displacement. We want to see large candles showing urgency. Step 3. Once that shift occurs, drop a limit order to enter long within the newly created discount fair value gap, which is that sudden pocket of empty space left behind by rapid price movement.
And I want to be absolutely clear on this point. Wait, there is no valid institutional confirmation yet.
if price simply bleeds lower without an energetic shift in market structure, or if it blasts straight through our invalidation level at 44.30, we cancel the idea entirely. No confirmation equals no trade. Capital preservation is the hallmark of professional trading.
This is where most traders get trapped. Retail traders are looking at the current consolidation and buying blindly, desperately hoping to catch the bottom. They're placing their stop losses just below the 44.80 level because a dusty 1990s textbook told them it's support. However, smart money isn't reading textbooks. They're actively waiting to run those exact retail stops. They need that internal sell-side liquidity to create the required counterparty volume to fuel their massive long positions toward 45.26.
The 1-hour time frame is currently flashing a massive warning signal. The vulnerable liquidity pool resting at 44.60 to 44.80 is a perfectly engineered retail trap. Institutions must attack this internal sell-side liquidity first. The algorithmic draw is pulling price down just to trigger those stop losses. Once the retail side is wiped out of the market, the true directional move to the upside can begin unhindered. Let's rapidly recap this entire trade plan. The higher time frame bias is definitively bullish on the daily and 4-hour charts. Our absolute target is the external buy-side liquidity at 45.26.35. Our execution trigger is a 15-minute bullish market structure shift, but remember, only after price sweeps the 44.60 internal liquidity pool. The setup is entirely invalidated on a clean 4-hour close below 44.30.00. And above all else, adhere to strict risk management. Maximum 0.5% to 1% risk on this idea.
If you value this level of precision and enjoy institutional-style market analysis using ICT and smart money concepts, make sure to subscribe to ICT Market Theory. And if you'd like to trade alongside these exact setups on a reliable platform, you can find the FXTM broker account link in the pinned comment below.
The macroeconomic data is coming. The volatility is guaranteed. The algorithms are set. The only question remaining is this: when the news drops and the market rapidly shifts, will you be the liquidity trapped in the sweep, or will you be trading right alongside smart money? Stay disciplined, wait for your confirmation, and trade the setup.